Now let's talk a little bit about behavioral finance. What is behavioral finance? To talk about behavioral finance, let's take a step back and first look at traditional finance. And traditional finance, it's technically what your degree is going to be in if you're a finance major. The instruction is based on theories developed under certain assumptions, okay? And but some of you may or may not know that traditional finance is often referred to by some people as modern portfolio theory. And this was developed by Markowitz in 1952. And some of the concepts of the theories are not necessarily modern and have been subject to much debate over the decades, academic debates, academic research, and writings. So traditional finance is premised on four basic premises, four basic principles, if you will. That in one, investors are rational. Investors are rational. So investors do rational things. All decisions that investors make are in line with what economic theory would suggest. So investors are rational. Markets are efficient. Markets are efficient. Prices reflect what prices should reflect. All possible information, all possible trends and analysis from companies, historically, past, future days. It's impossible for you to game the market. There's a mean variance portfolio theory that governs this whole concept. Returns are determined by risk. Returns are determined by beta. You should be familiar with beta. Beta is a measure of risk. Okay, not total risk, but beta is a measure of risk. Risk that can no longer be diversified away. Okay, so this is market risk. So these four tenets or four basic premises are essentially what traditional finance is based on. Okay, but I dare to ask you, are you truly rational? And do you believe that markets are efficient? And this is extremely important in later discussions in this semester. Because if you truly believe markets are efficient, it will determine an investment approach, whether or not you become an active investor or whether or not you become a passive investor. Okay? So behavioral finance does not reject traditional finance. That's not what it's doing. It does not do it fully anyway, but it challenges some of the fundamental concepts. And it challenges concepts that are based in lessons learned from traditional finance. So behavioral finance amends some of it with basic assumptions based on normal, more human-like behavior. Remember, one of the tenets is that humans are rational, investors are rational, but we know, and you know, even from your own behavior, there may be some psychological or sociological conditions that may alter your behavior, that may not be societally rational, or what economists may be considered to be a rational decision. Okay, so that's the whole posit of behavioral finance, that there is some sort of mediating factor that might move us away from this concept of being rational. So their assumption, behavioral finance practitioners' assumption, is that investors are not rational, rather investors are normal. And what makes investors normal instead of rational, the fact that as investors, we have both cognitive biases, we have potential errors in our decision making, and we're just being human. We make mistakes. Behavioral finance practitioners also believe that markets are not efficient. Markets do not reflect all information. The price does not reflect all information. They go forward and say it's not mean variance of the portfolio theory that governs this, it's the behavioral portfolio theory. What's the impact of cognitive biases? What's the impact of inefficient markets on overall returns? And they truly feel that risk alone does not determine returns. Risk alone does not determine returns. So it's more than beta. It is more than beta. So here are some patterns of cognitive biases. Anchoring, confirmation bias, gambler's fallacy, herding, overconfidence, overreaction, prospect theory. You may have heard of some of these things, but we're going to go through a few of them right now. What does it mean to anchor? What does it mean to anchor on something? What is anchoring? Well, it's attaching your thought process to a reference point. Even though you may not have any relevance or reasons to be focused on that reference point, no legal relevance, or this reference point is not even pertinent or relevant to the issue or question at hand. But you focused on this anchor, you've anchored, you've drilled down, you're stuck. It's also known as conservatism or belief preservation. You could also call it conservatism or belief preservation. But it's fairly common. It's fairly common in situations where decisions are being made in situations that are novel or new to the decision maker. So because you're not sure, you don't have a frame of reference, your focus is, in this current situation, you focus on something that you may have known from the past. Like, for example, and I this probably isn't even a good example of this, but I don't know if who are following B.O.B. when he's saying that the world is flat. He still truly believes that the world is flat. I mean, why is this a discussion in 2016? I don't know. There's no potential relevance to any issue that's going on, but he came and he's making news that the world is flat. So he's anchoring. Then we have confirmation bias. What do you think this is? A common phrase to explain the confirmation bias is that you do not get a second chance at the first impression. You do not get a second chance at the first impression. People tend to filter the information and focus on information supporting their own opinions. You already think you're right. So you're having a conversation, or you're having a debate or disagreement, and all you hear the things that validate the fact that you think you're right. That's all you hear. That is all you are focused on. Confirmation bias. Gambler's fallacy. One of the incorrect assumptions from the world of probabilities. In the realm of probabilities, misconceptions can lead to faulty predictions as to occurrences of events. So you're playing, what is that, roulette? Oh, it's not going to hit red 5 times in a row. It's not going to hit black 5 times in a row. You will never land on 00. That's the gambler's fallacy. The misconception can lead to faulty predictions as to what will occur in an event. Then we have herding. This is common. I've seen this a lot. People tend to follow the masses. We tend to follow the masses, don't we? Belief that herding is based on is that a person's desire to conform or be accepted by a certain group. People believe that if such a large group of people believe something to be correct, then the chances are that that conclusion or decision they have made is also correct. Herding. We follow the masses. We do what the masses, group think. We don't think for ourselves. Hindsight bias. Hindsight is 20/20. Looking back after the fact is known. Looking back after the fact is known may cause an investor into believing that they can perform better or more efficiently when armed with this bias. When you already know hindsight is 20/20. You already know the fact. Now you're getting this sense of confidence. And you feel you better understand the strategy now that you know a fact. Well, that fact might actually change, wouldn't it? And you could see we might tie into overconfidence, right? Remember, some of these are some of the behavioral or cognitive biases that we observe. Men were usually more overconfident than women when it comes to decision making. Doesn't mean we're always right. We should listen more. Usually concerns an investor that listens mostly to himself or herself. We truly believe in what we're saying. No one can tell us how we are wrong. An investor with overconfidence Usually most relies on their skills and their capabilities to do their homework, to make their own decisions. So we so believe we are right, we could do anything. We don't need help. We don't need to ask any questions. We don't need to ask for help. You know, you're driving on the highway, you're going to some town you've never been to before, you're lost. So I don't need to stop for directions. I know where I'm going. Sounds familiar? Overconfidence. And overconfidence leads to excessive trading, missing trends, missing returns, upswings, buying too high, selling too low. Overconfidence. Then we have overreaction. And this is common. How we react to news of a report. Overweighting sample information. What does this mean? You hear the news item say, oh, I remember. A lot of you are probably too young for this, but in 2000, Y2K, they said that the internet was going to shut down and blah, blah, blah. The world was going to end. It was going to be absolute chaos. And January 1st, 2000 came and nothing. But we had an overreaction to it. Okay, let's see. Apple recalls their adapters for the cell phones, for the iPhones. Overreaction. What does the market do? Apple drops 15 points. Facebook's profits went up 52%. No one asks 52% from what? But Facebook stock soars 16% that day. I'm not complaining, I own Facebook. But overreaction. People tend to follow the news. All that glitters, something that's glittery, it's in the news. Then we have prospect theory. Provides that people value gains and losses differently. So let me give you an example. I don't know how many of you have ever been to Las Vegas, or maybe you've gambled, or maybe it could be something just for fun. You've lost something. Okay, but using the Vegas example, you're playing blackjack. You won $100. You feel really good. I just won $100. Okay, you continue playing. You lost that $100. Think about how you felt. Do you feel the same gaining $100 as you did losing $100? Do you think it was equally weighted, the change in your mood? Or was the loss affecting you more than the actual gain? And actually the loss, then you lost 100 and you're like, I need to get back my 100. So you become more risky. You take more risk, right? You become more risk seeking. I'm sure you could think of other examples. But that's the concept of prospect theory. We tend to weight gains and losses differently. And we base decisions on what the perception of what this gain is going to be, rather than perceived losses. And the disposition effect is very rampant. Investors tend to be reluctant to realize a loss in a behavioral framework. When cognitive bias has a faulty frame, where normal investors do not mark their stocks to market prices, investors create mental accounts. So we do some mental accounting. When they purchase stocks and continue to mark their value to purchase prices, even after market prices have changed. Stick with me. They mark stocks to the market only when they sell their stocks and close their mental accounts. So instead of taking note of, okay, I bought at X price, I bought at that price, they tend to only focus on when they sell. So a normal investor do not acknowledge the loss in value, because an open account means that there is still a chance the stock price will rise, but may still turn into a gain even though you have a loss right now. The normal investor does not consider the stock a loser until the stock is sold, at which time the loss is technically realized in the mind of a normal investor. This is how they explain the disposition effect, but essentially it's when you buy high and you hold it to the point where it's extremely low and you can't recoup your profits. So this is just a brief introduction to some of the cognitive biases. Behavioral finance is a very fun topic, and unfortunately we won't go too much more into it in this class, but it's important that you have an idea of some of these things, because some of your clients or future clients may actually suffer from some of these cognitive biases or cognitive preferences. So we have to be able to identify them. Interfacing with faulty framing bias is the cognitive bias of hindsight. So we had a good discussion, and read up a little bit more on them, understand what they are. You should be able to identify them going